From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Hello, it's Friday, June 7th, 2019. Happy Jobs Day. You're listening to Hamilton Place Strategies Macrocast with our friends from Markets Policy Partners. Every Friday, we take a look at the major economic policy and data stories of the week. I'm Tony Fratto, founding partner at HPS. You can check us out at www.hamiltonps.com. We also tweet at HPS Insight, and I tweet at Tony Fratto. I got to know John Fagan during his time running the markets room at the U.S. Treasury Department, and Brendan Walsh when he was a senior analyst at Discovery Capital covering global financial institutions. Today, John and Brendan run Markets Policy Partners, where they provide independent financial market analysis for public sector audiences, among others. You can find them at www.marketspolicy.com. John and Brendan, happy Jobs Day to you both.
Thanks.
This is our first show on a payroll, non-farm payroll Friday.
That's a big one.
So we just got the data. The headline numbers are for May, 75,000 net job gain. That was disappointing. I think the expectations were around 175,000. Unemployment rate held steady at 3.6%. Labor force participation at 62.8%. But you also had downward revisions for March and April. So disappointing from that perspective. What did you guys see in the data? John or Brendan? Go, Brendan. Yeah.
So the ADP data on Wednesday kind of pointed to this.
That said that was 27,000 private sector jobs, which sometimes people don't know how to take.
Yeah, it's
ADP.
Volatile, and sometimes it's predictive. Sometimes
but it's a low number.
That was definitely a low number. The thing that I tend to look at, and a good friend of mine, Lenny Santow, who was a longtime Fed staffer and then Fed washer, says watch the revisions. The way the BLS kind of does things is as the new data come in, they don't estimate it. They don't predict it. If it comes in worse, they revise down. If it comes in better, they revise up. So the fact that we had negative 75,000 revisions in March and April is a little bit of a worrying sign.
We've had, it's not unusual to have a year with a month with a low number.
No.
And we've seen that a lot through this very long jobs expansion. You have it. But
and that's important to keep in mind, too. I mean, it's still 175,000. It's not. In terms of the averages.
165 or so. Yeah. Definitely not bad average. But if you wanted to look for the dark cloud next to that silver lining, it's that you had we have had 2 months now below 100,000.
Yep.
This year we had a nice number in January. Everybody, we had a nice number, and GDP looked better than people thought. Market rebounded. People feeling really, really good in January. Then, but the numbers since have not been great. I mean, a good number last month, but three of the 5 months this year have been disappointing. And 2 of those months coming in at below 100,000 net job gains for a month. So I think that starts to worry. I always compare that the thought that came to my mind is when you're making microwave popcorn, and you get towards the end and the pops start slowing down a little bit. That's a time to go in and get that bag out of the microwave, no matter how much time you still have on the clock.
No, you're right. And that analogy kind of is indicative also of the wages. So we were at a high of 3.4%, and by all indications, the labor market's incredibly tight. But we went from 3.2% year over year now to a very disappointing 3.1%. That was kind of the one outlier that people are pointing to, which could keep the Fed from hiking. And now it seems like we've taken away any worries of wage inflation, and that's seeping through to the PCE.
And Brendan, I think you make a good point there, saying that this was one of the very few things that was standing in the way of a Fed rate hike, at least in the minds of some analysts.
Wages.
And it was wages and the ongoing strength in the labor market. Mm-hmm. It was something of an isolated, continually robust indicator that kept coming in strong when a lot of the other data points that we've seen from the rest of the economy have settled down a little bit here.
Yeah. And I'm not saying that the Fed should hike, but one thing when you watch, and I think people don't quite understand that, is when the unemployment rate bottoms, it's very quickly when it starts to rise. It's not a gradual thing. So we kind of find our bottom, and when that bottom's hit, we tend to go back up.
But on wages, it seems like the pace of increase has turned, right? I mean,
totally.
So and that seems to be a bit.
We really went fairly quickly from we were stuck in that 2.5% range, and we very quickly went up to that mid 3.5%, and we've just not just stalled,
tailed
but
off,
reversed.
Yeah. The other things in the jobs report itself, there is I mean the composition of job gains. I mean, that was pretty dismal with retail, manufacturing, construction.
So retail's on a yearly basis, retail's lost 76,000 jobs. Mm-hmm. The other interesting thing is maybe this could be a Hamilton Place Strategies study, but so we lost 15,000 government jobs, and most of that was in the education. So what seems to be happening is the baby boomers are retiring, and we don't have enough people to replace them.
That's interesting. So that's not a cyclical.
No, that's more of a demographic issue, and we're going to be facing that for the next 15 years, right?
As we look at checking out CNBC right now, the Dow is up around 165 points. So
optimism.
What is it? I mean, if you're reading the markets, how are they interpreting?
How would
this
you
print?
describe this to the Treasury?
Yeah, there are a variety of catchphrases that would apply to an equity reaction to a non-farm payroll number like this. One is the good news is bad news.
Yeah.
And I think that speaks to the big focus this week prior to the jobs number, which was squarely on Fed easing expectations, building to a real crescendo here this week. We've obviously seen the market begin to price in Fed rate cuts with a greater likelihood later in the year, but this week featured a really dramatic escalation of those expectations as rate cut forecasts, at least market implied rate cut forecasts, were pulled forward pretty swiftly and meaningfully. So
that was this week before the jobs print, and since then,
right? Yeah. So we've seen that obviously the ADP earlier in the week that came out and accelerated the trend. The trend of greater pricing for rate cuts in the coming months, of lower Treasury yields, and this has worked to sort of stimulate equities this week. But that trend had been going pretty quickly, but accelerated this week because of the ADP number that came in early. But also it got started last week with the unexpected threat of tariffs on Mexico.
Yeah.
That started it out on Friday, and certainly this week featured a lot of Fed speakers, including most prominently, of course, Fed Chair Powell.
Powell himself. Yeah.
And the formulation of their policy characterization and communication did change. It changed pretty markedly.
Yeah, they're not sending signals that the market is wrong to expect rate cuts, are they?
I think that's
am I being charitable?
That's a nice way to phrase it.
Yeah.
They certainly didn't dampen those expectations when given the opportunity earlier this week. There was a conference in Chicago that Fed Chair Powell spoke at, and a number of other Fed speakers weighed in. Fed Chair Powell really set the tone by basically taking the previous formulation that we heard in the last Fed meeting of patience. That was the mantra. We're going to be waiting. They like where the economy is now. They're going to be in wait-and-see mode, dependent on how things are breaking. But clearly what we've seen here this week is a shift in tone toward Fed Chair Powell didn't even say the magic word patience at all. In fact, it was the new formulation is act as appropriate.
Yeah.
And
that
the
really
topic of the conference was specifically on Fed communications. So if you can take him at his word.
There was going to be a place that you were going to,
not try to overthink it.
Could communicate it correctly.
And so given all of this, the Fed shift in rhetoric, the low ADP numbers, last week's imposition, the lingering, trade threats around now Mexico, but also China as well, that added between the time we did this podcast last week and now an extra rate cut plus is priced in over the next to year end. So that's 2 plus more fully, potentially a little bit higher, but 2 fully priced in.
Yeah, tell me what they're what you're seeing on what they're expecting in the months ahead. Are you expecting a June rate hike, or is that
personally? Yeah. I do not expect a June rate hike. The odds, I mean, yes, right. A rate
that would
cut.
be surprising.
That would definitely be surprising.
Yeah.
I do not expect a June rate cut personally, but clearly there's building momentum for cuts in the coming. When you look at the Fed Fund futures implied odds, it's a 1 in 3, about a 30% plus chance of a cut in June.
That was up from about a 1 in 5 percent chance when we began the week.
That's right.
Yeah.
And that goes back to the predictive power of markets, where we were kind of laughing that the equity market is very optimistic. There's this popular narrative that the equity market's kind of a bunch of silly fools running around throwing darts at a board, and the rates market is where the adults are. But when you look at historically, especially the Fed Fund futures predictive power, from 2009 basically until the Fed started hiking in 2016, the Fed Fund futures were just way too optimistic. They were thinking every year we're going to hike 2 to 4 times.
Yeah.
And then when the Fed actually started to hike, they've been just way too pessimistic.
Why is that? I mean, you showed me a terrific chart earlier this morning on how they've been wrong in expecting where the Fed is going to be. Why is that? Why is that? I mean, is it? I mean, to some part of it, you are believing that the policy action the Fed is taking is going to be successful. Also, right? I think I don't say this as a Fed critic. I mean, I think they have. Yeah. I think the Fed. I think FOMC has a really difficult job in trying to imagine the future and signal for the future and do it in the right sequence and scale, right? It's like these are human beings trying to sort this out, and it's a really difficult thing. Yeah, so I don't say
the whole world effect.
Exactly, there are lots of factors, a very dynamic environment, and as I remind people, they have to do something which is predict the future on output. When it takes us 3 estimates to determine the previous quarter, really the one that's already done, right? It's finished, and it takes us 3 estimates to get that one
and
right.
And they can be dramatically different, those estimates.
Absolutely. So, so if you're off, by a few points, a few tenths of a point in the near term, that magnifies over the next 18 months or 24 months.
Think the Fed that has more information than you and I do, and that's just not
they're
the
using
truth. They know everything that you.
Yeah, they're using most of what we're all seeing too, and so it is. It's a judgment. It's difficult, and so I don't say that critically, just that. But there seems to be there's a miss.
And also with Fed communications, there's the aspect of selective listening.
Exactly.
Exactly.
That's a really, really important point.
As a father of 2 young kids, selective listening is something that I'm well familiar with. But Fed Chair Powell's comments earlier this week were something of like a Rorschach test.
Yeah.
Market participants look at a melange of comments from the Fed chair and focus in on the confirmation bias aspects of it. They hear act rather than act may sound a little louder to their ears than as appropriate.
Yeah, exactly. Right, they're human beings like the rest of us. We all hear that way. All right, we're going to take a break. When we get back, I want to talk, get us back onto because we can't escape talking about trade again. You're listening to the Macrocast, and we'll be back with John and Brendan. All right, we're back. I'm Tony Fratto from Hamilton Place Strategies with John Fagan and Brendan Walsh from Markets Policy Partners. This is the Macrocast. Guys, I keep, I'm like a broken record on this. We keep wanting to not have, trade influence our macro thinking, but here we are again. We're like in like a Bond film now with, the digital readout to the bomb clicking down, and that's Monday or this weekend as to whether we're going to get 5% tariffs slapped on Mexico. President Trump announcing this last week that his intention to do this. This is dealing with the immigration crisis at the border, not for economic issues. But here we are. We still don't have a decision. The Mexicans came in earlier this week. There were meetings. They didn't come to an agreement. And so here we are with likely a weekend decision from the president as to whether we're going to have tariffs on our most important trading partner.
Yep.
What do you?
Going back to the optimism in the market, there is a narrative going around Wall Street now that Trump actually is kind of the puppet master.
Are you going to tell me a market's conspiracy theory?
Yes.
Let's hear it. This is the place for that.
Yes. That Trump, we have the election coming up. If we're not far away, and he's actually, I think, giving his opening speech in a few weeks. That Trump is really playing hardball on this, delaying China and now bringing Mexico into it, which came out of left field, to force the Fed's hand to cut. So now he's going to get his July cut. We go to the G20. All of a sudden, trade disappears. Economic growth.
Both China and Mexico.
Both China and Mexico. Yeah. Economic growth and markets rally massively into the 2020
he
election.
Would.
What do you think?
Well, look, he does want to. He has tried bullying the Fed. He's tried using the bully pulpit to tell the Fed what he wants. He's had others out there saying the same thing on his behalf as well. I think the Fed's probably headed in that direction. I think his people are probably telling him. I think if I'm Kevin Hassett, who our friend Kevin Hassett will be leaving the White House soon. He announced last week. Is probably telling him the Fed is heading in that direction. Yeah. So. I have another view on it. I think actually, he keeps telling us what he wants and what his intention is, and like he's the tariff man. He likes tariffs. He does not like our economic relationship with Mexico. The thing he likes or dislikes even more is our people coming across the southern border. That's the thing that has most animated him. Here's the Fratto conspiracy theory, although I don't think I'm the only one who has said this, is that he wants to put this 5% tariff on the Mexicans. We've heard him say with the Chinese tariffs that the Chinese are paying. They're paying. Yes. The money's flowing into the U.S. Treasury from the Chinese, and we know it's not. We know it's coming from U.S. businesses and consumers. But he says that. He believes it.
And genuinely believes it.
He genuinely believes it. I think he's going to do the same thing with Mexico. And I think he wants to say the Mexicans are paying. They're putting money into the U.S. Treasury. And now that money, we need to go take it and build that wall on that issue that is the single most important issue to him, it seems to be, which is keeping people from crossing the southern border. So, and that fits in a campaign context also. Totally. He said he can come back and say, I told you I was going to make them pay, and they're paying. And this is why I think he really, really wants these tariffs. And I don't think the market is really prepared for that. I think they think that red digital readout clock is going to tick down and someone's going to come in and save the day on Sunday. And we're going to hear that all things are good and the Mexicans are really going to take care of this. That may be the outcome.
Right.
But I put it at 50-50. I could see it.
And I agree with you. That could be the outcome, but that's not the puppet master game plan. We could end up there, but it'd be not the reason why we started all this stuff.
Yeah. And with the rebound this week, you can just it's pretty clear that the fixation has been on the market's fixation has been on Fed rate cuts, but also supporting the equity rally this week. The bounce back this week has been building expectations for something to occur on the trade front. Just as you said, the expectation that this weekend they'll tie it up with a bow with Mexico, and or at least delay it. There was a headline yesterday in the afternoon that the White House was contemplating delaying the imposition of Mexican import tariffs past Monday. That rallied the market. Subsequent denials and reports that refuted that previous report were ignored.
Yeah, well, today, 20 minutes after we get the weak jobs number, they announced that they're going to delay some tariffs on China till the 15th.
Certainly on the equity.
They know how to play the game.
On the equity desks of Wall Street, the biggest sin is missing a rally. Yeah. And so then this year has been, the rally has been so swift from the depths of despair at the end of December.
Yeah.
So many investors have missed it, and they're underperforming the broader index. The S&P is up almost, I think it's up 14% year to date, and there are plenty of money managers that we know that they're lagging that. And in that environment, when you're behind the eight ball in terms of your performance, you're less worried about perhaps going into the weekend and having bad news bring more downside to you. You're more worried about missing the potential upside if you have something of a compromise with Mexico, U.S.-Mexico compromise. And if Secretary Mnuchin comes out of the meetings this week, the finance minister G20 meetings this weekend after meeting with the PBOC governor Yi Gang, and says, what a constructive meeting. We're talking about restarting negotiations or something like that. You can just picture that headline really levitating equity prices on Monday. And so the fear of missing out, I think, particularly given the degree of underperformance that a lot of money managers have.
So you think you buy into this today? You have a lot. I mean, if you are looking at equities, you have those potential. We do have, or at least have a very strong sense that once they can put a bow on China and Mexico, that there will be a lift in the market. I mean, I know there are discussions with Japan. I don't think they're particularly serious. And at the very least, I think they're on a very long train. UK is on a very long train. EU is on the longest train. Maybe will never happen with these two administrations, or with the Europeans and Trump administration. But if you get those two things out of the way, probably equities we'll see a pretty good lift, and then expecting the Fed to continue to be supportive. I
think that's exactly right. The only, I guess the nuance would be on Wall Street, there's a percolating there's a developing understanding that a resolution, the U.S.-China trade issue really isn't going to be as neat and tidy in all likelihood as they had perhaps thought and hoped in months prior. The idea that all of this can be resolved with one deal, whether it's the Huawei, the tech transfer, just the all singing, all dancing across the front.
I think you're right about that. But is it your view that the market does feel that way? I mean, I felt that people are misunderstanding what a China trade agreement is. Look, I do think if there's an agreement, they have a signing ceremony on something, or an announcement, there will be a lift in the market. I don't know that that's I don't know that that's I don't know that that's where the market ought to go, but I think that's what will happen. I do think that there is a misunderstanding of what a China trade agreement is.
Totally agree.
To think of it as an end when it's actually a beginning. Yeah.
But on the flip side, the thing that I don't know the answer to this, so I'd be interested in your take. If the data and the markets get weak enough that Trump decides that this trade hardline stance is hurting him in the election, and he just flips and he goes to China and just cuts whatever deal China's willing to take, which would be a weak one. Does it matter what it is? Is he strong enough with his base to be able to, to convince them that he cut the strong deal?
Yeah, I don't think. I think from an electoral standpoint, his base isn't his problem. His base will be there for him. They will be there with great enthusiasm. I think, what do they believe about what he's done on trade? They will believe exactly what he tells them. Yeah. It's the fact that he's never gone above that ceiling to reach into other people who are skeptical of him and don't like his style of leadership, and in some cases don't like policy. So he hasn't done a lot to reach out to those people. He's done. We've seen now. 25 months of, base support and no reaching out to broader populations yet. So I don't think that's his problem, but I do think, but I don't know that I don't know if it's strategic or this is just.
No, I don't think so. But I think there's that narrative on Wall Street that he'll just do whatever he needs to do to get reelected. So if the numbers start showing that this isn't winning, he'll just back away.
He certainly has,
but I don't know if that's true.
And that featured in one of the other stories this week that built up the market narrative that the U.S. Mexico tariff threat may never play out, which was indications that Senate Republicans might actually try to thwart these, or congressional Republicans, basically. They would have the numbers to overrule White House. What's your take on that?
I think if they don't have the means to, they could do it, right? But what it would take to do it at the end of the day is an agreement between Nancy Pelosi and Mitch McConnell, and I think the there are things that I can imagine happening. That's not one I can imagine. Right. So Nancy Pelosi and Mitch McConnell getting together to embarrass the president.
Right.
Now they did they did try to do this earlier this year on the funding for the wall spending. We were able to get legislation passed. He vetoed it. They didn't have near the votes to override the veto. I think it would be a replay. Yeah. In this case, but I also think in this context right now, that was easier to do it on that one. It would be very difficult to do it on this one, on the president exercising authority under IEPA. I don't see that happening. So I think they don't like it, but I don't see them actually doing anything about it. And if anything's going to do anything about it, it might be market reaction. It might be real cost and disruption that might get them to come to the table and pull it back. I mean, the Mexicans are coming forward and saying they are going to do some stuff. Right. It's up to him to say whether that stuff is enough. Yeah. So so that's we'll see whether how that plays out. But I'm not looking to the other end of Pennsylvania Avenue to solve it.
Right. It'll be very interesting to see on Monday if they do kick in at 5%, whether the equity market, which is now obviously in full-on rally mode, we had a tough Monday, but then we had turnaround Tuesday, and it's been no looking back.
Yeah, it's the first week. It looks like we're up 230 points now. First week, I think positive week in a while. Right. So we'll see. Okay, we're going to go to our last break and then look ahead to next week. But before we do, what's your prediction on the 5% tariffs, Brendan?
I'm going to go eat as much guacamole for lunch as I possibly can.
I'll wait till this evening and go and have tequila with my guac and get as much as I can too. I see it happening. John?
I agree. I think it goes to 5%, and I think the equity market tries to laugh it off as just another stage, and to push the Mexican government to do just that incrementally more.
Okay, let's take a break, and when we come back, we'll look ahead to next week. Okay, we're back with the Macrocast. John and Brendan from Markets Policy Partners. All right, so let's take a look at at next week. We have data coming. What are you guys paying attention to?
So we have a bunch of balance of trade data out of China, the U.S., and Europe, which normally the market wouldn't pay a ton of attention to, but with the trade negotiations, we'll focus a little more. Then on Wednesday, we get U.S. CPI, which has been at the Fed's 2% target, but unfortunately, they pay attention to the PCE price index, which is at 1.6.
Right.
On Friday, that's kind of the big day. In the U.S., we get retail sales, which has been a little volatile, but kind of disappointing over the last few months. And then in China, we get Chinese fixed asset investment, industrial production, and retail sales for May. John, what do you think about that?
Yeah, that trio of Chinese data points always gathers attention. Certainly now it will be with recent PMI data coming in for China on the weak side, looking soft. We have concerns about global growth, obviously in the context of China, but looking at these is also going to be taken in the context of recent discussions, commentary by Chinese officials. Yi Gang, the People's Bank of China governor, overnight was extolling the resiliency of the Chinese economy, how it was strong enough to see off all these challenges. And it'll be interesting to see if these data points are in line with these.
Absolutely, and then whatever else we see coming out of the finance ministers meeting this weekend, also.
Lighthizer not going to that. What do you think about that?
We used to keep trade negotiators away from G20 meetings. We didn't. It's Treasury's show. Yeah, we don't. That's finance ministers. We don't like those guys coming in and mucking things up. Yeah, you don't have too many chiefs in the room there. So yeah, we used to never let them come anyway, even if they wanted to. Okay, so big week ahead next week. We'll have a lot to dive into, and I think by this time next week, the retail sales actually I think is interesting to see whether it confirms some kind of trend. I agree, it can be volatile, but it may confirm.
The trend's been in the wrong direction.
Yeah, exactly. Okay, so for John Fagan and Brendan Walsh from Markets Policy Partners. Thanks for tuning in to the Macrocast. I'm Tony Fratto. Enjoy your weekend. We'll be back with you next Friday.
Thanks for listening to the HPS Macrocast, Produced by Hamilton Place Strategies in association with Markets Policy Partners. For more from Hamilton Place Strategies, follow us on Twitter at HPS Insight. For more from Markets Policy Partners, please visit marketspolicy.com.